Howdy, Jacob here. Today we're looking at Newmont Corporation. It is in the metals and mining industry with $40 billion on market cap, $42 billion enterprise value. It looks like they engage in the production and exploration of gold, and they are headquartered in Denver, Colorado. Growth of the company, $8.4 billion in revenue in 2013 to $11.9 billion in 2022. Return on invested capital is really all over the place based on their earnings being positive and negative. I would say an average is probably low single digits. So looking at that, it makes sense that they're paying a dividend. The good news is the gross margin and operating margin are both up in the last 10 years from 18% to 25% in 2022, and then operating margin from 10% to 14% in 2022. They pay a dividend of 4.65%. There wasn't a lot of debt, but let's look at the balance sheet. We see that they have no short-term debt currently, $5.6 billion long-term debt, which is actually down from 10 years ago, and then cash and cash equivalent of $2.8 billion, up from $1.5 billion. So their balance sheet has improved, and they still have about just under $3 billion in net debt, but not very concerning. Let's see, look in relation to cash flow. So on a 5-year average basis, we are probably seeing $2 billion, I would say, $2 billion free cash flow for a 5-year average. Their aggregate dividend payout is $1.4 billion. So that's a good amount of their average free cash flow. But it looks like after they had a humongous $4.7 billion free cash flow year, they jumped it up a lot. They're $2 billion of free cash flow based on their $5.5 billion in long-term debt with, $3 billion in cash on hand. That's pretty safe. I'd say that their balance sheet is very safe. Their earnings were all over the place, but their free cash flow has been positive since 2014. And again, like I said, 5-year average of, let's say, $2 billion. That's pretty healthy. And their use of cash flow, a little bit in acquisitions, a little bit of investments, a little bit of stock repurchases, recently a bit of debt repurchase, so that's pretty cool. Just good that the company is mindful of their debt situation, and it's actually not that bad. So their leverage ratio from free cash flow is healthy enough, and with their cash on hand, to where they can go to straight optimizing, to where they're making acquisitions when they're maybe going to increase their margins, repurchasing shares when it's stupidly cheap, and then if there's nothing else, maybe pay a dividend, or maybe keep cash on hand and just invest it into cash-like products that are making 5.5% essentially risk-free. And so I think I'm ready to start making some assumptions. I'm going to say that a little bit of growth, probably in line with inflation, saying that everything they mine will just go up relatively in line with inflation. So after 7 years, this company's been around long enough. Well, they'll figure out how to keep business flowing. They've been around since 1916, so they've been around for a while. Margins are all over the place, so I'm just going to take an average roughly for my initial assumption. And then shares are actually up a bit recently. I don't see any acquisitions, so that's interesting. I'll say I'll just say no share change, and then I'm probably fine where the dividend is right now, because we're looking at almost the 60 to 70% range on a 5-year average free cash flow basis. But again, their balance sheet's healthy enough to where I don't necessarily want to deduct them for it, but they also have other uses of free cash flow, really acquisition and common stock repurchases, to where I want them to advantageously have 30 to 40% of free cash flow a year being able to be allocated towards that. And then otherwise just reinvested into products that are pretty short term, to where if opportunities do arise, you can really pounce on them with the cash on hand. And the debt situation is not too concerning at the moment, to where they really need to pay down that debt unless they want to completely deleverage themselves. But that gets us to a price that needs to fall quite a bit, 59% before you get a 15% return, given these assumptions. I do think that that dividend of 4.6% is relatively stable. And then the main things that I like are that consistent earnings or consistent free cash flow, a low leverage ratio, and then a low payout ratio. And I'd say that their balance sheet is pretty attractive. Their issuing of debt or their dividend issuance is their dividend ratio, is more than I would like, and I'd prefer to be extremely healthy. But I do think that they do have a good amount of cash on hand, and their free cash flow is definitely positive enough to where I'm comfortable with where it's at right now. So if you're just looking for that dividend, you don't really care about price appreciation, you just want 4+%, and this could definitely be an interesting company to look at. So hopefully everyone enjoyed this and has a great rest of the day.